just happened to Paychex? Here's a company that's the #2 payroll processor in the U.S., specializing in small and medium-sized businesses. So you'd think that with the employment situation in the country so strong, Paychex would roar after its report its earnings. But the company reported this morning delivering in-line earnings and higher than expected revenues, with its human resources outsourcing business doing particularly well, yet the stock got slammed anyway. It's down $2.10 or 4%. Sure, it's a down day. Now, some of that is because Paychex ran up into the quarter, but there's also a concern that growth isn't accelerating at a pace in keeping with employment growth in the nation, and there's no rate increase on the horizon to allow Paychex to capitalize more on the float. Still, the overall numbers here were solid. Paychex reiterated its full-year guidance for 2015. And after today's pullback, Paychex is paying you to wait for higher rates with the bountiful 3% dividend. Now, even after today's decline, stock's still giving you a 7% return with dividends since we last spoke to the CEO back in December. So can it keep working its way slowly higher? Let's check in with Marty Mucci, the president and CEO of Paychex, to hear more about the quarter and where his company's headed. Mr. Mucci, welcome back to Mad Money.
Thanks, Jim. Good to be here.
Marty, I have to tell you, given we have that big national payroll number and it's so good, I was surprised that you said, and I'm quoting from your release, from your conference call, checks per payroll grew, but more moderate rate than we projected. When are things really going to start going higher here?
Well, I don't know. I think that small business may have led the way a little bit in the job growth. And so we were stronger a little bit last year. It's moderated some. I still think it's positive. You know, we're up 9% in revenue, service revenue year to date, and our profits are up 6%. So I think, you know, we've had a good year to date, and we're sticking to guidance. So I think it's just we got to see where it ends up.
But some of the best growth still comes from what I regard as being the onerous government putting regulations in that they need Paychex to be able to figure out.
Well, that's for sure. I mean, HR outsourcing is our fastest growing ancillary product. This is on the PEO or ASO side, which is we're providing that HR support to help be compliant. Also, our Affordable Care Act products that are helping clients with the Affordable Care Act requirements are really picking up traction now. We had great sales in the third quarter, and we think that's going to continue right through the year.
Now, I thought there was a really interesting comment in the call where you talk about how there was a point where some companies came public, people kind of sampled them, and now they're coming back. We had a company, and I'll mention the name, TriNet, that had a not that great quarter. And I'm wondering, I know they say they're still getting clients, but are you beginning to take guys back from the so-called SaaS names, the software as a service companies? They came in, made a splash, and maybe you're taking it right back now.
Look, we are, Jim. That's absolutely what we're seeing. You know, what's happened with us, over 80% of our clients are on our SaaS product. It's a full, the full suite of products that we have. It's integrated. And I think what people are seeing is they're trying someone else, maybe for a little bit lower price in the short term, but what they're not getting is the service and the full breadth of the products that we offer. So we are seeing some losses that were small, and now they're coming back to us.
Well, we should go over this because you did say that this was a selling season where you said that over the last year, this is probably the best sales results in selling season we've seen. So what I'm trying to figure out is if things moderated, why did you still have the best selling season?
Well, the moderation is really in the check growth, so the checks per payroll. So what we saw is that slowed down. So the hiring of the existing clients tended to moderate and not grow as fast. I think it grew faster early and then started to moderate out. So I think they've done some of their hiring and are now being careful. The biggest sales season was new clients, more product, more revenue per client than we've seen, but the sales were double-digit revenue growth on an annualized basis, and it's the highest we've seen in probably 7 or 8 years.
I mean, well, that does say something. I mean, I think it was very interesting in answer to a question about where these new greenfield business is. You're talking about how the 50 to 500 is doing okay.
Yes, it is. Both the under 50 and the 50 to 500 in particular are really doing well. They're the ones that need the full suite of products for the most part, and that's come down even below 50. You know, we're seeing clients with 20 employees now looking for HR outsourcing because they need help with Affordable Care Act compliance, they need help with immigration reform compliance, and we're seeing that come down in the size of the employer.
Marty, are you seeing anybody who's actually reacting and saying, listen, I'm not going to open a new business or I'm not going to add more people because I am too concerned about affordable care? That had been a fear right about now at this point in the year.
I think you still do see some of that. I think it's more cautious than anything, Jim. I think what you're seeing is, you know, if I have a couple of pizza places, I may not open that next one. I may not open the next shop. I may just be careful to expand a little bit. We're also seeing part-time employment up. So I think, you know, there's still this positive but cautious feeling from small business to see what exactly is going to happen with the political scene, tax reform, Affordable Care Act, those kind of things that are going to cost them money.
One of the dominant themes today, Marty, in trading is that Europe is doing better, particularly Germany. You have a German payroll business. To read the papers is to think that Germany's really on fire. Are you seeing great growth there?
I wouldn't say it's on fire. I think it's been steady and moderate growth in Germany. They seem to have been the strongest of the European countries, and they've been very steady. So we're seeing small business growth there, but I wouldn't say it's on fire. I'd say it's very moderate, but continued.
All right, excellent. I know that your stock has had a history of selling off in the day it reports and then going higher, because we know it has been going higher and higher since we've been talking the whole way. Marty Mucci, thank you so much, the President and CEO of Paychex. Good to see you, sir.
You too, Jim. Thanks.
All right. 3% yield, market coming down, nice, great place to be. We've been behind it now for about 15 points. I'm not changing my view. Mad Money's back into the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.